Ladies and gentlemen, good morning. Very pleased to have you with us today. We hope very much that you're safe, that you're healthy, and clearly all of us look forward to getting to the other side. We welcome you to one of our many UCLA Ziman Center programs. Today we have with us Dr. William Dudley, Bill being the former president of the New York Fed. I'll get to that momentarily. Bill will speak to issues of the COVID pandemic, the macroeconomy, and monetary policy. A couple of logistics before we begin. There's a Q&A feature at the bottom of your Zoom screen, and we very much encourage, as does Bill, your participation and your questions with respect to the topics that we will cover today. You may submit a question via the Q&A button, and we will see that question and we will attempt to get through as many of those inquiries as possible. So again, thank you for your participation. Now on to William Dudley. Bill completed his PhD at the University of California, Berkeley in 1982, hence he's a part of the University of California family, and we're deeply appreciative, Bill, of you coming back into California today. From UC Berkeley, Bill went to the Fed, from there to Wall Street, and from there to a series of ever more responsible and auspicious roles in analysis of the US macroeconomy, rising to the level of partner, managing director, and chief US economist for Goldman Sachs. This was a position that Bill had held for more than a decade. He went from there back to the New York Fed. His timing was auspicious. He arrived in 2007, literally perhaps days prior to the outbreak of the global financial crisis. Initially, Bill served as the leader of the markets group, the group that implements the monetary policy voted on by the Federal Open Market Committee via open market operations at the New York Fed. He was appointed president of the New York Fed in 2009, and this is when his predecessor, Tim Geithner, was appointed as Secretary of the Treasury. You heard Bill's name often during the period of the global financial crisis. He worked very closely with Chairman Bernanke, with Chairman Yellen, and with Vice Chair Powell as they formulated strategies and vehicles to mitigate some of the adverse effects of that crisis. So Bill is one of the few individuals in our nation who is deeply, deeply familiar with crisis-related management at the Fed, with a plethora of Federal Reserve liquidity vehicles put into place in the context of a crisis. He's uniquely qualified today to provide some insight with respect to the status and prospects of the U.S. economy, Fed response thereto, the Fed vehicles put into place, and all the rest. So Bill, it's a pleasure to have you back with us at the University of California. Some of us only briefly left, and we look forward very much to your presentation. So thank you.
Thanks, Stuart. It's good to do something with you again. We were classmates at Berkeley, so we go back a very long ways. So thank you for having me do this. Well, as Stuart said, I hope everybody can stay safe during what's obviously a very difficult period. I want to begin my remarks. I'm going to make some brief remarks for about 10 minutes, and I want to make 5 broad points. The first point is an obvious one, but I think it's very important. This is unlike anything we've experienced in our lifetimes. And so that means that we have to be really humble about forecasting what lies ahead. The fact that we haven't gone through this before means that there's no good template to turn to benchmark how this is likely to unfold. And there's a high level of uncertainty on a number of key points. For example, what's going to be the course of the virus? Will it naturally recede in the summer and come back in the fall? Can we sustain social distancing? And if we can, how effective will that be? What are the costs going to be of social distancing in terms of economic activity? Will effective antiviral treatments be developed in a timely way? When will we have an effective vaccine that we can use to inoculate our population? And how much damage will the coronavirus cause to household and business balance sheets? And how will households and businesses respond to that damage? The answer to all these questions are going to determine how this plays out. And I think there's uncertainty about each and every question. Second point I want to make is essentially, if you think about what's really happened to the U.S. economy and the economic outlook, what we've had is a sudden stop in terms of discretionary economic activity. That's been necessitated, of course, by the need for social distancing to slow down the spread of the virus. Over the medium term, we need to practice social distancing to limit the number of cases and deaths and to buy time to develop effective antiviral treatments and vaccines. In the shorter term, we have to practice social distancing to prevent our healthcare system from being overwhelmed. And because if the healthcare system were overwhelmed, that would make matters worse in terms of more people actually dying. This social distancing that's required is leading to a collapse in outlook and output and a sharp rise in unemployment rate. Initial unemployment claims, which is one metric that we see on a weekly basis, have risen by, we've seen 30 million filings for initial unemployment claims in the last 6 weeks. That means that the U.S. unemployment rate, when we get the next couple months of data, is likely to climb to 15 or 20%. That's unprecedented since the Great Depression. And when we get real GDP at the end of the report at the end of July, we'll see a record decline in real GDP in the second quarter. Now that's all pretty sort of pessimistic. So what's the positive side? Well, the positive side is compared to the great financial crisis, the policy response has arrived much more quickly, and I think it has been considerably larger. If you look at the fiscal policy stimulus, for example, the total bill so far is about $3 trillion to date, and it's pretty broad. We've had draft payments to households. We've had unemployment compensation benefits extended and increased. We've had forgivable loans granted to small businesses if they retain their payrolls, and $454 billion of Treasury funding to support the Fed's emergency lending programs. The major outstanding question at this point on the fiscal side is whether there's going to be a big package of aid to state and local governments. This is important because if that's not forthcoming, state and local governments will have to tighten their belts, and that would mean more layoffs and more downward pressure on economic activity. The Federal Reserve's also been extraordinarily active, cutting short-term interest rates to zero, instituting a broad suite of emergency lending facilities that backstop the commercial paper market, the corporate bond market, the securitized lending markets, and the municipal debt market. And there's a special new program to lend to small, medium-sized businesses, where the Fed is basically going to be a participant in loans originated by depository institutions. Fed's also reactivated its foreign exchange swap programs. This is when the Fed lends foreign central banks dollars that those central banks can then lend onto their banks. They're having difficulty obtaining dollar funding. And the Fed has engaged in quantitative easing at a massive scale, buying hundreds of billions of dollars of treasuries and agency mortgage-backed securities already. And these programs have been broadly successful. Financial markets are actually functioning reasonably well. When I talk to market participants, they say that the problem is not market functioning. The problem is the economic outlook. Compared to the global financial crisis, I think the policy response has been a lot faster and more aggressive for several reasons. First, the need came on much more quickly. This is moving much faster than the great financial crisis. The need is much greater. The collapse in economic activity is much more sizable. And another important difference is that the political support for an aggressive response is much higher. And I think that's because the enemy is the coronavirus rather than a bunch of bad actors in the financial system. So it's been much easier to gain support for both fiscal and monetary policy stimulus. Also, I think it's helped that we had the great financial crisis in one respect. The Federal Reserve developed a lot of things that they didn't have before the financial crisis, and those were on the shelf. And it's much easier to take programs off the shelf that you already know how to implement than to develop new programs from scratch. Also, on the fiscal side, there's been a general view in the economics profession that maybe large budget deficits don't have as much negative consequences as we previously thought. And as a consequence, there's been much less aversion to using fiscal policy stimulus to support the economy than what we saw during the great financial crisis. Fourth point is, this is all good that we're having a really terrific policy response, both on the fiscal side and the monetary policy side, but that response will not be able to prevent a sharp and deep recession. This is very different than the great financial crisis in the sense that the policy response can only mitigate the second and third round impacts of the coronavirus pandemic. Fiscal policy measures can support income. The monetary policy measures can ensure that the markets keep functioning and we continue to get credit to borrowers. But neither of those things can prevent the initial sharp drop in economic activity. In contrast, during the great financial crisis, it was the collapse of markets and of the financial system that was driving the economy downward. Here, the causality is quite different. Then if you fix the financial system, you actually could have an okay economy. Here, stabilizing markets and the financial system is necessary, but it's not sufficient to stabilize the economy. And the final point I want to make is the future is really going to be determined by the course of the virus and the ability to develop an effective vaccine. The future will be determined by the willingness of people to stay the course and practice social distancing in a sustained way. Even if reopening of the economy occurs, it's unclear that people are going to resume their activities, given the risk of contagion and contracting the virus on a going forward basis. I suspect personally that we're going to end up at either one of two places. First place is herd immunity. Eventually, 75–80% of the population is going to get the COVID-19, or we're going to come up with a vaccine that's going to allow us to have a protected, inoculated population. If herd immunity is where we're headed, that's not a good outcome because the death toll will be considerably higher, and the transition will be longer and more costly, and the benefits of social distancing will be smaller. It would just be more about delay than avoidance. Hopefully a vaccine can be developed in a timely way. And if we do that, we'll actually avoid deaths and we'll keep people more healthy. And that's what we have to keep our fingers crossed, is that the scientists will be able to come forward with that in coming months. Regardless of which outcome occurs, we are going to see a bounce back in economic activity beginning, a little bit in May and then more in June and July as the economy opens back up. Whether this turns out to be better days or a false dawn is unclear to me. I mean, it's very possible that we could have a second wave of the pandemic in the fall, which might necessitate a whole second round of social distancing. Regardless of whether we have one wave or two, I think it's going to take us a long time to get back to the old peak in economic activity. People are going to be reluctant to resume their old activities as long as there's a significant risk of contracting the virus. And households and business balance sheets are going to be quite damaged by the sudden stop that we are experiencing today in activity and the sharp drop that we're seeing in incomes. So even if everything goes away tomorrow, we'll still have the balance sheet damage, and I think that will inhibit discretionary consumer activity and business investment for months and possibly even years ahead. So with that, let me turn it back to Stuart.
Well, that was truly excellent as a mechanism to encapsulate both dimensions of disease and epidemiology, and of course, the relationship of the disease cycle to the economic cycle. So thank you very much for that. Bill, maybe we'll start with your fourth point. And in your fourth point, you, of course, alluded to the fact that even with the very vigorous efforts on the part of the monetary authority and on the part of Congress to sew together a response, a social safety net, and all the rest, that this is going to hurt, and it's going to hurt a lot of people. And in fact, there's been so much written, and I know you've seen so much of this, that relates to the inequality of virus incidents, the fact that we see it more in communities of color, this, that, and the other, as well as the inequality that relates to an economic downturn. Now, I raise this point because, as you, of course, could very finely articulate, the Federal Reserve really isn't designed to do redistributive policy. Redistributive policy is first and foremost the responsibility of Congress, and it's sewn into the taxing and expenditure dimensions of fiscal policy. But that said, the Fed has put some vehicles into place that may have some distributional implications, if not formal distributional direction of activity. And those, of course, include the Main Street lending vehicle, as well as the implementation of other vehicles that relate to paycheck protection and the like. I'm wondering if you might, however you wish, address some of those issues.
Well, you're absolutely right. I mean, monetary policy tools are really about stabilizing markets and stabilizing the economy and generating a return to economic growth. They're not very good at addressing where the fruits of those of that growth, who that actually benefits. There's a pretty strong presumption that having a healthier economy, probably lifts all boats to some degree, even if some boats get lifted a little bit more than others. Look, I think it's challenging for the Fed in terms of coming up with a response to the pandemic. And one really important point, it's relatively easy to implement facilities that deal with tens or hundreds of counterparties, but it's very hard to implement facilities that deal with, tens of millions of counterparties. So it's very hard for the Fed to do things where they can actually, participate in lending decisions to, households. And very small businesses. And that's really why the fiscal support from Congress in terms of extending unemployment compensation benefits, sending checks to households, the Small Business Association lending program to help support businesses maintaining their payroll is so important. Because the Federal Reserve, even if it wanted to do that, it really wouldn't know how to operationalize it quickly. It doesn't have the connections to individual households that would allow it to stand up that type of facility. Some people say, well, the Fed should just backstop everything. Well, that would be nice if they could actually figure out how to actually do it. But the Fed is sort of stuck with the plumbing that exists in the financial sector. And, historically, it's worked only through with large banks and large securities dealers, because those pipes already exist. You could build new pipes, but that would take time. And, the need is today. It's not, 6 months or a year down the road.
Yes, of course. Bill, let me then follow up on a couple of things you just mentioned. The fact that the Fed, in a normal course of action during a non-crisis period, would implement monetary policy via government paper dealers on Wall Street, this, that, and the other, but not with the massive number of counterparties that might be associated with a Main Street lending program or with a payroll protection program or whatever. How has the plumbing of the Fed, or at least the implementation capacity of the Fed, been augmented in this period of crisis to get us to where we need to go with these programs?
So the Fed essentially tries to bootstrap its operations by relying on the people that have the infrastructure, have the plumbing, have the expertise. So, for example, commercial paper funding facility where the Fed will buy commercial paper, they're going to hire a private firm to basically service their back office. Someone who already deals with a lot of commercial paper issuers, so they already have the pipes and the operations. Main Street lending program, the Fed is basically outsourcing that to depository institutions. And basically, it's telling depository institutions, if you have a smaller business borrower who wants to borrow, we're willing to buy 95% of that loan, and you just have to keep only 5%. So the Fed basically relying on the depository institutions to do the essentially loan underwriting to decide whether the loan is a good loan or not, and the Federal Reserve will essentially outsourcing that. You think about in terms of what the Federal Reserve is willing to buy in the corporate bond market. They're outsourcing much of that to the credit rating agencies, because they basically said we're only going to buy corporate bonds that are rated BBB or higher, or if you were BBB or higher prior to I think it's March 12th, and you're subsequently downgraded, you still qualify. But then essentially the credit decision is being outsourced to the credit rating agencies. And so that's the way the Federal Reserve can essentially, expand its capacity and implement these programs relatively quickly. Now, what's interesting about it is, for example, the corporate debt facilities that the Federal Reserve is standing up just started to become operational this week. So this week is the first time that they're actually going to start to buy corporate debt. But even before it became operational this week, it was actually having very positive effects on the functioning of the corporate debt market. Big borrowers like Carnival Cruise Lines and Boeing Aircraft went to the corporate bond market and raised tens of billions of dollars. And I don't think that would have been possible if people didn't know that the Federal Reserve essentially stood behind the corporate bond market and was going to make sure that the corporate bond market was supported broadly. So it's interesting that the effects of the facilities can actually start to appear long before the facilities are actually up and running.
Well, thank you, and it's really interesting that you mentioned that point. Here at the Anderson School, we're going to have a seminar next week where a couple of my colleagues in the finance area are going to talk about a paper they just wrote. It's a COVID paper. It was sort of written overnight, and it's exactly what you described. It's an event study about a Fed announcement and implications for debt yields. And they look at debt yields across the capital markets, and they see, subsequent to the announcement, a very significant contraction in those yields. So I guess this goes to what you might call the communications channel for the implementation of monetary policy. Maybe if you want to just say a few words about that channel. I'm not sure if people really appreciate that channel or what's intended to be there.
Well, you have to have credibility, right? I mean, if you announce programs and people think that the programs are, vaporware and they're actually not going to materialize, or they're actually poorly structured so they won't work, then you won't get a positive announcement effect. But the Federal Reserve, I think, had a pretty good track record in the great financial crisis in terms of enacting programs that actually worked. And so I think now market participants, don't fight the Fed. They sort of, have a sense that the Federal Reserve will be effective in the programs that announce it. This is why it's really important not just to throw a bunch of spaghetti against the wall and hope that some of it sticks, because every time you introduce a program that doesn't work, it affects your credibility in terms of future announcements.
Yes, okay, very well. So, Bill, one of the things that you mentioned that's, I think, really interesting to all of us, and kind of comes under the category of compare and contrast across this crisis and the one prior, and also the operations of the U.S. Federal Reserve relative to other major central banks around the world, such as the Bank of Japan, is this idea of what indeed is the Fed purchasing. And as you recall last time around, initially the purchases were extremely narrow. With the declaration of exigent conditions, the Fed added to its standard purchases those the securities of what we call the GSEs, the government sponsored enterprises in the housing area of Fannie Mae and Freddie Mac. And we would compare that with what was going on in Japan in the lost decades, where we were sort of left scratching our heads because the Bank of Japan was essentially, they're buying equity indices, they're just sort of buying everything under the sun. So now we wind the clock to today, Bill, and as you described, and as you and I were talking about just a couple of minutes ago before this whole webinar started, the Fed's going to be buying a lot of stuff underwritten elsewhere, underwritten in community banks and financial institutions and all the rest. And some of that could comprise relatively high risk paper that was originated for high yield debt finance. And maybe just say a word or two about that in terms of appropriateness or concern or endorsement, or however you want to describe it.
Well, the first thing is to be very clear that the Federal Reserve Act is pretty narrow about what the Federal Reserve can actually purchase. They can purchase treasuries, they can purchase agency mortgage-backed securities, they can purchase foreign sovereign debt, which they've never done, and they can purchase short-term general obligations of municipalities, which they've up to now never done. That's in normal times. Then in times of unusual and exigent circumstances where there's incredible stress on the economy and credit is not broadly available, the Federal Reserve has an authority called Section 13.3, which allows it to buy other stuff. And so essentially what the Federal Reserve does is it sets up a structured investment vehicle that buys corporate bonds, buys municipal debt, and the Fed then lends money to the structured investment vehicle who does these things. In principle, you could set up a structured investment vehicle to buy just about anything under the Section 13.3 Act. But the Fed has to basically be aware of a couple things. Number one, that credit's not available from another source. Two, the things that they're doing they're doing versus solvent borrowers rather than insolvent borrowers. And it's really important that the Federal Reserve not take losses on its balance sheet. That's why the CARES Act, which gave $454 billion to the Treasury, for the Treasury to backstop the Fed facilities, was so important, because the Treasury is essentially taking that first loss piece. The chances that the Fed will take losses on these facilities is very, very low. The chances that the Treasury will take losses on these facilities is considerably higher. The Fed basically wants to stay out of the fiscal policy arena. So if you have legislation which allocates the money for the Treasury to potentially lose, that takes the Fed off the hook, because the Fed is not in harm's way in terms of actually taking losses. So this is a situation where there was a pretty broad agreement between the Treasury and the Fed, between Congress, the Treasury, and the Fed, that we wanted to backstop these markets. To backstop the markets effectively, there needed to be some money at risk, and that's the Treasury's money allocated by Congress, and that's what gives the Fed permission to engage in these kind of facilities.
Okay.
Do this without Congress's and the Treasury's blessing.
Yes. Very, very interesting. So, Bill, another question that arises here, and kind of implicit in the remarks that you just made, has to do with the relationship between what is intended to be an autonomous, independent central bank and agencies of the U.S. government that are almost by definition partisan. So that is agencies of the executive branch of government, or whatever. So, going back to the charter of the Federal Reserve, and to kind of the level of central bank independence that all central banks strive towards, the idea is that, and I'm not sure if our audience fully appreciates this, the Federal Reserve is the only independent autonomous agency of the U.S. government that's not part of any branch of government, and structured that way so that when conversations take place at the Fed, they're not based on what's good for Democrat or Republican re-election chances. They're associated with what's appropriate for the U.S. macroeconomy. So you take that and you overlay on that recent conversations between the Fed and the White House, or recent interactions between the Fed and the Treasury. And you see sort of historically, if you look back, that there were periods of time when the Fed worked more closely with the Treasury, one of those notably being World War II, but then other periods where really none of the above. So maybe, if you don't mind, Bill, comment for us even philosophically on this issue of central bank independence, the current relationship between the Federal Reserve and the Treasury, and how you view that relationship, how you view that relationship going forward.
Okay, so I think the important point here is the Fed should be independent with respect to the conduct of monetary policy, because you don't want to politicize monetary policy, to support one party over another party, especially as you get into the electoral season. So the Fed basically wants to be completely out of the political process. That said, if there's a strong consensus in the country to take certain types of actions, and the Fed can be helpful in facilitating that, then that I think is perfectly appropriate for the Federal Reserve to do. I mean, the Fed has basically been given permission for what they're doing today by Congress. And Congress did not pass this legislation in a very narrow, parochial way. There was broad support for this legislation from both sides of the aisle. So I think in this particular circumstance, I'm not at all worried that the Federal Reserve's independence is compromised in any significant way. I think the Fed is doing basically what they did during the Great Financial Crisis, which is working very closely with the federal government, with Congress and the administration, to do its part to support the financial markets, to make monetary policy accommodative, to support the economy as best as it can. So there's no tension in terms of the goals of Congress, the administration, and the Fed here. I think they're all trying to head in the same direction towards trying to support the economy and having the economy be as healthy as possible in what's obviously a very difficult set of circumstances. So I don't think there's any conflict here. So I'm not worried at all about the Fed somehow, giving up its independence in some way that's going to make it more difficult for it to execute monetary policy in the future. I think we saw last time, once we got out of the great financial crisis, the Fed started to pursue its monetary policy with independence again. So I think it's really important to distinguish between sort of wartime and peacetime. When you're in wartime, sort of all hands on deck, and when you're in peacetime, then we can talk about the independence of monetary policy.
Right. No, that's a very encouraging message, Bill, and I think we're all pleased to hear that. Going back to the prior crisis again, one of the things that was, I think, immediately evident as we entered that crisis was very deep concerns with respect to solvency, with respect to a myriad of different financial institutions. Some bailout of financial institutions, some too big to fail, other institutions that did fail, and also some real variability in stringency amongst regulators. And I remember talking to Janet Yellen at the time at a conference at Berkeley about her concerns with respect to the myriad of regulators and the stringency of some of those regulators with respect to the health of the banking sector. So, Bill, maybe compare and contrast them and now. Rather than talk about the monetary policy function of the Fed, maybe say a few words about the banking regulatory function of the Fed and how you see things currently.
Well, the good news is we had the great financial crisis, and as a consequence of that, we basically changed the regime for banks. They had to hold much more capital. It had to be higher quality capital, common equity. They had to have liquidity buffers. We subjected them to pretty severe stress tests. So the banking system is much stronger and much able to absorb economic stress than it has been in the past. So going into this situation, we have a pretty robust banking system where before we had a very weak banking system. And in fact, the banking system was a source of much of the problem as we went through the great financial crisis. Now, that's not to say that the banking system is sort of, invulnerable to any degree of stress. Depending on how the economy evolves, we're going to see banks' earnings suffer, and it's even possible that some banks could actually take some losses. But we're starting at a much better position. And the second thing I would say is there's also a lot of support coming to the economy from the Fed and from the fiscal authorities. So that also provides a sort of floor under economic activity. What I worry about more is not the banking system, but is the part of the financial system that is not the banks. A lot of credit intermediation activity occurs outside of the banking system, and that works fine during normal times. But when you get into a period of stress, all of a sudden people start to pull back, and businesses start to say, "Oh, I better draw down my credit line at the bank. I'm no longer going to raise the money in the capital markets." And so a lot of activities tend to start to crowd back into the banking system. And that makes it hard for the banks to actually meet all the demands that are not there during peacetime that arise during wartime. So we're going to have to see how that unfolds going forward. And that's one reason why the Main Street lending facility is set up in a way where the Fed is going to take 95% of the loans because the Fed is saying, okay, we understand your balance sheet capacity is limited. So we're going to essentially expand your balance sheet capacity. You originate the loan, you keep 5 cents of the loan, we'll keep 95% of the loan. That essentially allows the Fed to lend its balance sheet to the banking system. The Fed is the only entity out there that has an infinitely elastic balance sheet. The Fed can take its balance sheet to essentially any size. The banking system is constrained by the amount of capital they have, the amount of risk they have in their portfolio. And so really the Fed plays an important role. I mean, that's why we have a central bank. Prior to 1914, when there was no central bank in the US, we would have these financial crises on a pretty regular basis because there was no lender of last resort that could essentially backstop the financial system. So that's why we have the Fed.
Thankfully so. Bill, I know that some of our listeners are interested in this issue that you just articulated with respect to sort of the blow up of the Fed balance sheet. So this idea that, we went from slightly below 1 trillion to 4.5 or thereabouts trillion in the context of the prior crisis. We'd embarked on a very well advertised and well executed plan to sort of gradually wind that down, wind down the balance sheet maybe to 3.5 trillion without severe disruption. And we were in the midst of that, and then of course all this hits. And now, as I think you've articulated, the forecast is that balance sheet could blow up to 8, 9, 10, 11 trillion dollars. Who knows? Are there concerns that come to mind here? Is it your sense that should it be the case that the Fed will be able to extricate itself, so to speak, in a manner that is not disruptive to the markets at some future point in time, or any comments you wish to make there?
Well, first of all, there's no size limit. The Fed can make its balance sheet as big as it wants. The second thing is basically that it really depends on what assets the Federal Reserve actually holds. So imagine if the Fed had allowed its balance sheet to build up to a very large size, but all the assets were Treasury bills. Well, then they could just stop buying Treasury bills and the balance sheet would shrink very, very rapidly. In this case, the Fed's taking on a mix of shorter maturity assets and longer maturity assets. The shorter maturity assets, they'll roll off very quickly. So for example, the foreign exchange swaps that the Fed is doing with foreign central banks, they have 84-day maturity. And so when the foreign when foreign banks stop borrowing from their central banks dollars through these auctions, the 84 days later, this will just disappear from the Federal Reserve balance sheet. But when the Federal Reserve is making 4-year loans and buying corporate debt and buying longer duration assets, and that's going to stick around in the balance sheet for a bit longer. And I don't think that's a serious problem, but remember, the Fed has liabilities that it has to fund itself with, and it has assets. The liabilities are mostly currency and reserves. The Fed right now pays essentially 25 basis points on its reserves, not very much, 0.25%. And it's on its assets, it's probably earning on the average of probably, I'm guessing, 1 to maybe 2%. That's not a problem as long as short rates are at zero. But you can imagine a future, a couple years down the road. Let's say the economy comes roaring back, or inflation starts to rise, and the Federal Reserve had to tighten monetary policy. Well, the yield on its assets would still be 1 to 2%, but the cost of its liabilities would be higher, and the Federal Reserve in principle could actually start to lose money because its net interest margin would turn negative. Now, the only way this can happen is if, lo and behold, things work out really well and we have a strong recovery, and the Fed has to raise rates quite a bit faster than anybody anticipates. So I'm not sure that we should be that concerned about this, because it would actually imply that the economy was coming back faster than what I thought. But the Fed has some balance sheet risk because it's basically funding longer dated assets with overnight funds and currency. Now the currency we don't have to worry about because that will just be outstanding. But the interest on reserves, that's an overnight liability. So you can think of the Fed as a little bit like a savings and loan, right? Borrowing short term, investing longer term. That's fine as long as short term rates don't go up a lot.
Right. Okay. No, that was extremely helpful. Bill, one of our listeners has a question about what happens to the tsunami of unemployment claims when the PPP funding expires this summer, and whether in your mind there is any anticipation of another PPP type stimulus to bridge further as the economy comes back.
Well, I think there's certainly going to be a case made, I'm sure, in Congress for an extension of extensions. Looks like it's warranted. I think we'll have to see how the virus pandemic persists and how the economy bounces back, and how quickly we resume. How big a bounce do we actually get in May, June, and in the third quarter. But I think people in Congress are already talking about potentially the need to extend the payroll protection program for small businesses. So I think that's definitely on the table, a potential extension of that program.
Right, okay. And along those same lines, Bill, you made a comment earlier in your presentation of maybe damp concern at this particular moment with respect to the magnitude of fiscal deficit. And if you feel like elaborating on that, I'm sure our listeners would be interested there as well.
Well, it's sort of interesting how the view of budget deficits has changed over the last 20 years or so. If you go back to the 1990s when Bill Clinton became president, Carville explained that he wished he could come back in another life as the bond market, because the bond market vigilantes basically drove fiscal policy. And so there was a notion that interest rates were very high, and the reason they were high was because of the outlook for big budget deficits. And now, over the last couple of years, we've experienced something very different. We were basically at the end of this economic recovery expansion. We're running persistent budget deficits of about $1 trillion a year, or 5% of GDP. And the bond market wasn't fussed by this at all. And interest rates were very low, both in nominal terms and also adjusted for inflation. And so the economics profession now has taken a much more optimistic view that we can run bigger budget deficits for longer than we thought without negative consequences for the economy. And so this, I think, is one thing that has essentially made it easier for the policymakers in the White House and in Congress to use fiscal policy aggressively because the negative consequences in terms of higher interest rates and high debt service costs just haven't materialized. Now, my own personal view is, there are no free lunches in economics. So, if we do drive up the budget debt burden significantly, as we are doing through this crisis, there will be a consequence on the other side. Whether it will manifest itself, 2 years from now, or 5 years from now, or 10 years from now, I'm not certain. But I think that it'd be better to come out of this crisis with less debt than more. At the same time, you want to have a viable economic recovery, and so you're trying to balance those two courses.
Right, absolutely. Bill, so as we survey the array of liquidity vehicles, and you certainly articulated, and we've discussed some of the new pages in the playbook, so to speak, this time around, relative to those that were brought back from the prior crisis. Do you yourself see any particular gaps or any glaring avenues of potential proactive policy that have not been undertaken?
Well, I think the Fed has provided pretty broad support to markets. The one notable exception is that the support for the high yield debt market is pretty limited. The Fed basically can buy a limited amount of exchange traded funds that invest in high yield debt, and they can buy the high yield debt of companies that were formerly investment grade prior to March of 2020. So the high yield debt market and the leveraged loan market are pretty unsupported, and so that'd be an area that you'd probably be most worried about. The municipal debt market, the Fed has basically said we can buy the obligations of states and large cities out to 2 years, but again, there's a whole bunch of municipal borrowers, the revenue bond issuers and things of that sort that don't have much support. So I think I think the Fed's support is broad, but it's not, across the board. We also have to remember here, what's the Fed trying to do? The Fed is trying to ensure that markets work well. The Fed is not trying to immunize people against loss. So the Fed wants markets to be functioning, but at the end of the day, it's really for Congress on the fiscal side to decide how they want to shore up different sectors of the economy in response to the crisis, in terms of the effects on their income and their ability to continue to function well. So the Fed focus is really about intermediation activity between borrowers and lenders continuing and functioning well, not to just keep everybody in business that maybe some people shouldn't be in business. Every year about 5 million businesses in the United States fail, and so obviously, coronavirus or not, you probably don't want to keep everybody in business. As somebody put it to me the other day, if you have a town with 10 restaurants, small town with 10 restaurants, and the coronavirus is going to lead to a much less demand for restaurants because of social distancing, do you really want to prop up all 10? Or do you really want downsizing to occur to 5 viable restaurants to serve the town going forward? So that's a difficult philosophical question how much support do you supply? You do want capital to flow to its most efficient uses, and so propping up companies that would not be viable over the medium to longer term is probably not a great strategy.
Certainly, very, very difficult.
Making that judgment is very difficult.
Certainly at the current moment, no question about it. No, many controversial elements of this. If I'm not mistaken, the Fed facility for state and local government is a new page in the playbook. Is that correct?
Yes. And the reason why the Fed has been very reluctant to wade into the state and local government arena is of a concern that where does it stop? What do we, for everything we buy, there's something that we're not buying, and how are we justifying that decision? Also, the Fed doesn't want to get involved in the specific issues of why a particular municipality is in trouble. Think about, when Detroit got into difficulty. If the Fed had come to the aid of Detroit, well, then that meant every time a municipality got into difficulty, the Fed was going to be on the hook to come forward. The Fed basically views those kind of decisions as really up to Congress, not for the Fed to make. So the Fed's trying to distinguish between lending to viable entities versus lending to people to keep them afloat. So there's a subtle distinction there between supporting markets versus supporting particular entities. And on the state and local government side, the Fed doesn't really want to wade into the politics of keeping some people alive and letting others fail. It's a very difficult place for the Fed to be.
Certainly. So we've had, in some respects, a rather technical conversation that relates to the implementation of monetary policy. We're getting towards the end of our time here. You started your presentation with comments about the virus, comments about uncertainty related to the virus, things that relate to epidemiological phenomena and all the rest. This is a form of what keeps you awake at night, and hopefully you're sleeping really well. I know you're in a safe place, but this is sort of the opportunity for a broad societal observation, if you wish to make one.
I actually do. I mean, I think an ounce of prevention is worth a pound of cure. And what's frustrating as we go into this pandemic experience is all the things that we didn't fix after the great financial crisis. So we had to bail out the money market mutual fund industry again. We had to backstop the commercial paper market again. We worried about people who were invested in mutual funds with overnight liquidity, where the assets of the mutual fund were very illiquid, and so people couldn't get out at reasonable prices. So there's a bunch of stuff that you sort of say, gee, we could be better prepared than we actually are going in. What typically happens is people talk about potential risks, and then they shrug their shoulders and say, well, we don't know if that's actually going to be a problem. And then we actually have a period of acute stress. The things that we worried about as risks manifest themselves. It'd be better if we took care of that a little bit sooner. And that applies to the pandemic as well. I mean, obviously, having more ventilators, having more protection equipment in place would have made it much easier to deal with the pandemic. So, more anticipation, more consideration of worst cases, taking out a little bit bigger insurance policies against bad economic outcomes. Ex ante makes it so that the ex post, the environment won't be quite as difficult. So I'm in favor of more insurance.
No, certainly wise words, and certainly a lesson that we're all taking to heart these days, the lesson of preparedness, on so many dimensions. Bill, it's been absolutely a delight to see you today, and to allow our listeners to benefit so greatly, to allow all of us to benefit so greatly from your wisdom, your observations, your reflections as a crisis manager. We wish you, personally, we thank you. We thank you deeply, and we wish you continued health during this period and hopefully a rapid emergence from the period. And we look forward to hearing about your future work at Princeton and to speaking with you again.